Welcome everyone to the Trading Alphas Options Masterclass. In this section we'll be covering risk management and psychology of trading. So to begin, we'll give a brief definition of risk management. So risk management is the set of strategies that investors use to minimize risk, combat volatility, and to protect your initial investing capital. So position sizing, hedging, and diversification are different ways that you can do this. So with position sizing, that's your initial buy-in for each position. Hedging is used to combat volatility, and diversification is used to help spread your money into different sectors. So risk management and fundamentals are tied together because ultimately the fundamental factors will lead to negative investor sentiment, which leads to increased selling and volatility, and also anticipated events such as earnings reports, Jay Powell's speech, Jerome Powell, which is the Federal Reserve Chairman. Anytime that he speaks, there's a lot of volatility, and any news that involves variants, COVID variants, and vaccine news. So to begin, we'll start with position sizing. So depending on your account size, it's recommended to use 1 to 5% per trade on your account in equal positions, and never full port, no matter how confident you are. If you have a smaller account, it's usually recommended to use higher due to how expensive options premiums are. So this is done to ensure that you have capital preservation and to combat volatility. So try to limit the number of positions you get into and avoid any unnecessary trades. So you can do this by buying 2 to 6 positions with options, and to avoid positions that are in the same sector. So a good rule to go in for a little bit with trading psychology is, are you okay losing 100% of the money that you put into a particular position? So that helps offset your emotions in the beginning. And if you're not okay losing 100%, you may need to dial down your position sizing. So always formulate a plan for when you want to enter and exit a position to decrease the risk. And always use your stop losses and take profit points. The next thing is hedging. So hedging is used to reduce risk in a trade from volatility. So hedging ratios are one way to do this, and it's based on how confident you are of a substantial move up or down. So this can be done buying maybe 3 calls to 1 put, 1 call to 1 put, 3 calls to 2, etc. But you want to avoid hedging in consolidation because that may not be ideal due to theta, and that will eat the contract. So ways that you can actually hedge is, so when you're in calls, which is for upside positions, you can buy an equivalent position on the put side. So that would be a 1-1 ratio. You can also play the major indices like SPY puts, QQQ puts, or SQQQ calls. So you do this when you're expecting major market moving news and a very large increase in volatility. You can also play the volatility indices, which includes VIX, VXX, and UVXY. So when you want to actually implement these hedges for calls is when you need to identify volatility in the overall market conditions fundamentally and technically. So make sure to identify the periods of consolidations and sell-offs so that you avoid implementing hedges in consolidation and being theta burned. And you need to plot your areas of support and resistances for VIX and VXX. So you can also do this by kind of looking forward on the technical side and plot significant areas of resistances on major indices. So you can do that by looking at the S&P 500 and identifying Apple, Facebook, Amazon, and Google. So going on to Thinkorswim, you can see here we're on the 4 hour. So you would identify important areas that you would most likely see a pullback in the overall market due to technical factors. Looking at Apple, you can see around 176, on Facebook around 343, and on Google you can see that around 3,000 is an important level to look for. Looking at VIX in this corner here, we can see that 19 is an important area. So anytime that you see that VIX is increasing, that there is going to be increased volatility in the overall market sectors. Another important thing to consider with risk management is diversification, and this is usually done in the longer term but can still be implemented with short-term options. So in order to minimize your risk, it's important to diversify your portfolio. So obviously if you're tech heavy and tech pulls back, then a significant portion of your portfolio is going to be affected. So look to buy things from different sectors such as tech, financials, healthcare, manufacturing and energy, etc. And you can also consider different companies from different countries. So try to avoid redundant positions, because ultimately all you're doing is increasing your risk. So the only reason or only time this would be acceptable is when there's fundamental differences within the positions of the same sector. So say one company just hired a CEO who is famous, then that would be, that they're different fundamentally.